Hey guys, Toby Mathis here, and today we're going to be talking about the top 7 ways to earn interest on your money. So 7 ways to make, what are we talking about? Interest. So we're not talking about capital gains. We're not talking about putting our money at risk. We're talking about making interest, letting somebody else use our money and pay us to do it. And what are the top 7 ways? All right, let's dive in. So if you've been listening to any of my videos, we talk about where to invest, how to invest, where to keep, your 3 months of emergency funds, where to keep another 6 months. And so the first area that we're going to be talking about is where we really want to keep about 6 months of emergency funds, and that is in a high yield savings. Now, I am not talking about your traditional go to the bank and open up a savings account. We want high yield. So a typical savings account might give you 0.5% or less. We want to be at a higher level. As I'm standing here today, we want to be around that 5% mark. It just depends. You're going to be looking and shopping between banks. This is not your checking account. This is not where you keep the money that you're writing checks on, or that you're paying on the for groceries, debits, and things like that. This is not like your typical living expense. This is really kind of more of an emergency fund, and we want to keep it very liquid. In a high yield savings, generally speaking, you want to stay underneath $250,000 because of FDIC insurance. So if you're at a bank, you want to make sure that you're keeping it below that area in case you have a bank failure. You don't want to lose a bunch of money. They're generally right now around that 5% mark, and you generally want to keep about 6 months of reserve in a high yield savings. So that's number one. And the type of income that you're earning on that is interest income. Where does it go on your tax return? As interest. It's ordinary income. So it's not treated as capital gains. It's not like a dividend. These are treated as taxable interest when you're in a high yield savings, but they're extraordinarily safe. You don't have to worry about waking up one day and hearing about the stock market crashing and losing 37 or 38% of your account value. Your account value is not going down. Number 2, you guys are probably used to this too, is certificates of deposit, or CDs. And again, you want to stay underneath that $250,000 mark. Again, we're right around that 5%, 5.5%, 6% range, depending on where you're getting your CDs. If you are at a traditional bank and you are scared to death about that $250,000 FDIC amount, you'll know that a lot of banks will group together and sell CDs through a partner bank. What does that mean? It means I could be at ABC Bank and I have CDs for $2 million spread out amongst other banks, but I didn't have to leave ABC Bank. In other words, they're buying multiple CDs in a sweep account where you have FDIC insurance on all of it. So you could have, you're going to be able to sleep at night knowing if a bank fails, I'm not going to lose money. It's still FDIC insured. So that's our second area. Again, very, very safe investing and getting interest income on those CDs. Number 3 is bonds. And there's different flavors of bonds, right? A lot of us are used to government bonds through the Treasury. You're getting a interest rate. Right now the adage is, as interest rates go up, bonds go down. As interest rates go down, bonds go up. So we've had a long period of bonds not doing particularly well, but there are still bonds available that are very safe, and you can get a decent, not the greatest interest rate. More people are going into these latter two than some of the others I'm going to show you. People are flowing their monies into other things, including, we're going to be talking about money market accounts here in a second. But you want to keep it on your radar. The old adage was 60-40, 60% in securities, 40% in bonds. Bonds have done nothing for the last years, nothing. So like all your growth has been in the security side. So a lot of people are ignoring bonds. I would say don't ignore them. Where they really are effective is not just the government side, but it's corporate bonds. When corporations raise money, those are fantastic. You can get a decent interest rate. And more importantly, muni bonds, municipalities, because they are tax-free. So if I have to choose between making 6% that's taxable versus 4% that's not taxable, I may be better off going that 4% route, depending on what your tax situation is, right? So a lot of folks don't want to make Social Security taxable, for example. They don't want to get into a higher tax bracket, or they don't want to throw in compound issues. So they go into muni bonds because they're tax free both on the state level and on the federal level. So it's under that category of bonds. So there's three different flavors. There's government, there's like Treasury, there's the corporate bonds, and there's the tax-free muni bonds. I imagine that there might be taxable muni bonds. I have no idea, but I just know that I always go tax-free muni bonds. Make sure that they're tax-free. Number 4, and this is really an interesting area. I happen to be doing very well in this area, but it's peer-to-peer lending. And this doesn't mean that you have to go out and loan money to your neighbor. You can use Ground Floor, you can use Prosper, and loan to other individuals as a group and minimize the exposure on individual loans. So for example, you can go into Prosper and say, hey, maximum of $50 per loan. Here's the qualifications. They have the credit status of the folks. They kind of do an A, B, C, D, E, F rating system. And you could say 2-year loan, 3-year loan, 1-year loan. Like you could choose the parameters and allow it to put your money to work. In this particular case, I could just say mine right now. I've been averaging over 11% on for return on peer-to-peer lending. It's not a bad place to be putting your money. It's not where you put all of your money, but it's fantastic for getting interest on your money, and it's definitely in our top 7. Number 5 is money market. And there's money market accounts, money market funds. I tend to focus on the on stock brokerage accounts that have money market fund accounts or money market accounts because number one, you're under kind of a different insurance realm. We're not just looking at FDIC. We're looking at SIPC, which is I think it's still 250 or 500,000, excuse me, for the SIPC. If you have cash, it's $250,000 of insurance. But what's different about a brokerage account is that it's actually your money. And because of that, it's not like in a bank where I put my money in a bank and it's on their balance sheet as an asset and their payment to me is a liability. It's when I go into a brokerage account, it's my account. It has my name on it. It's almost like putting my money in a safe deposit box, and I am putting it into an account and I am making interest on that money. And it tends to be higher than on our savings account. It tends to be a higher minimum, though, that you're able to put in there. And then there's usually different types of insurance on top of it. So for example, Raymond James, I just had a email. They have an amount that is insured up to $3 million individually, $6 million jointly, and it's a enhanced savings account where you're getting a higher interest rate. So it's a money market account with a higher interest rate than I would get in a savings. But the minimums are more too. In that particular account, it's $100,000 or above, but you have a much higher level of insurance. And again, the reason being is because when you're putting your money, generally speaking, into a brokerage company, they're not putting it into their bank. Like, let's say you're putting it into Schwab. Schwab has a bank side too, but if you're putting it with the brokerage, it's your money. There's actually a third-party trustee that's allocating those funds. So it's not like I just gave it to Schwab, and if Schwab goes under, I lose my money. It's not like that, like at a bank, where if the bank goes under, now you're trying to get your money back. In this particular case, my money is my money. It's earmarked for me. They're just investing it. They're just placing it. Subtle difference, big impact, especially if you're worried about banks going under. All right, number 6 is doing notes and loans. Oops. So when we're doing this, you could actually be out there buying notes, first trust deeds on real estate. Again, there's plenty of places you can do it. I believe Ground Floor actually does a lot of that. If you wanted to go out and actually bid on actual notes, you get there's a little bit of a discount. So you're able to buy notes and make money on the note. You could actually turn some of these notes. There are note buyers out there. Or you could just make loans of your own accord. You could be a hard money lender, private lender to folks. Maybe it's family members, maybe it's close friends, maybe you're doing it as a business, in which case got to make sure you know what you're doing. But you can be doing notes. There's also lending clubs where you're doing kind of more the peer-to-peer, but you're doing hard money loans to, let's say, for construction projects. Maybe you're doing it directly to folks that are doing flips. Maybe you're doing some of those things where you're joining a group, and what they're really doing is matching up people to actually lend them money. Or you could be a note buyer where you're actually buying the notes that are in existence. You can be going to banks, you could be going to individuals. There's lots of lending clubs out there where they do this sort of thing, and you might be looking around saying, hey, does anybody have a private note? Maybe it's a hard money lender, and I'll give you a discount. Maybe you're buying it at 95 cents on the dollar, and now you're making a nice return. So there's notes and loans. Now, this one I would just say with a caveat, make sure you know what you're doing. Get some training first to make sure that that you don't make mistakes, because mistakes in that accord could be, oh shoot, I don't have a I don't have a first trust deed. I'm in second position, or I'm completely unsecured and I lose my money. It's one of those things with risk rewards. These are a little more risky. You can have them secured with assets. Maybe it's UCC. Maybe you're doing that type of lending, or it could be a mortgage against a property or a deed of trust against a property, so that if somebody doesn't pay, you get the property. There's always that, but those are fantastic. Another way to do it. I'm just going to leave it at that. Let's just call that notes and loans. And then number 7, this is something that I do, and that's syndications. This is your BlackRocks, this is your Blue Owls. These are some that are lending to private equity. Some of these are doing big groups of loans, and they're holding them in funds, and they're out doing kind of the note buying, getting the discount, but they're doing it for you, and you're getting paid interest. Or you have a fund that is for a particular purpose. Again, private equity would be one. Sometimes it's going in a particular market, distressed properties. Maybe they're going in and trying to take advantage of the marketplace and what's going on right now with the higher interest rates. But they're syndicating it, and you have somebody who's actually running it. Instead of you doing it, you're just an investor. And in case they're giving you interest income off it, that's a great place, again, to make interest. And so we just went over 7 ways to make interest, and those are my 7 top ways right now that you can make interest. If you like this type of content, please like and subscribe. And if you know anybody who could benefit from this information, please share it. Otherwise, I would say thank you for watching. 7 ways, the 7 top ways to make interest income on your money.